All right. All right. All right. Happy Tuesday. What a great day it is to be alive and a great day to be talking about our taxes. And we are getting closer and closer to the ability here to file. We've got about 3 days left before we can actually file individual tax returns. That's when they're going to open up the e-file floodgates, and everybody and their mom is going to try to file at that time. We have a couple due dates that are coming up here pretty soon. So for S corporations, the S corporations partnerships, those are going to be due on 3/15. So that's March 15th. And then our individual tax returns, individual taxes due are going to be on 4/15. And so I just wanted to kind of talk a little bit about what kind of form you may have to file depending on how you're organized, what the organizational structure really looks like at the end of the day, tax wise, and what may be advantages and disadvantages of each and every single structure that there is. And so I wanted to go through these with you, and we'll go ahead and start, not with that one. We will start sharing the other screen. Share away. All right. So DBA, or just you as the business, right? So this is this is when you are either filing a doing business as and getting an EIN number and functioning underneath that different EIN number, or if you're functioning as a sole proprietor, right? So DBA, kind of equated the two here. Sole proprietor is also equivalent to a DBA. It just means that you can go by a different name than you as the person. For a lot of people, especially contractors or people that may be working, commission-based contracts, sales, with as a recruiter, obviously that's a lot of times that's contingency-based commissions. So let's say you're working contingency-based commissions, you get a 1099 from somebody that has gone out and found the employer. You get a 1099 from them. You get your commission split, or however that works out. You're going to get a 1099 at the end of the day from that particular company. And if you do not have a company or entity structure in place, that's going to land on your Schedule C on your individual tax form, right? So that's the Form 1040. You're going to have a Schedule C that you're going to be reporting your business profit and loss deductions on. So in case you might not know how to kind of go through and get something like that together, we do have some work papers at our website. If you go to tuthillcpa.com, you can find a work paper that's just going to kind of go through some of the basic details. If you go over here to the help section, there's a section called information gathering. And it's going to go through some of the details on what kind of categories and organization stuff like that we need as a business owner in order to report our income appropriately. So these are just general categories, right? And the reason why I provide this is, for a lot of people, especially contractors, they don't really know what all is deductible, and maybe they've got some stuff that's intermingled. But a lot of times it's for people that don't really have a lot of expenses and don't really keep track of their expenses that well. How do we get and combine all of our expenses at the end of the year in order to report as much as we can, right? What is deductible? What isn't deductible? A lot of that stuff is highlighted here, right, by these categories. So revenue sales, that's your 1099 income. If you had certain purchases that were used to make that income happen, you're going to have like a cost of goods sold purchases or something like that. You're going to have different categories here, right? Depending on what it is: bank charges and fees, advertising, consultants, contractors. If you had freight, business gifts expense, they are limited to $25 per person. And we just go down the line. There's just a couple of different expenses here that you can list out. If you have equipment, you can list it right here, that total cost of equipment that you purchase it for, whether you contributed it or not. This is one key indicator, especially if you're just new and just starting up. Your computer that you may have had personally, you contributed at the fair market value at the time of starting the business. That's a big, important one. A lot of people miss that, right? So that may be your desk that you had for the office. If you're just starting up, you should take those. Those are deductions for you. If you had a vehicle that you had for a business, you want to list your business mileage, any other mileage, total mileage, and stuff like that, right? A lot of the times your business mileage is going to be better off than other types of deductions, but there are other times in which you really, maybe you're in a tax situation you're not quite prepared for, maybe the first couple of years or something like that. If you use your business vehicle for more than 50% if you use your personal vehicle for more than 50% business, you can start taking some of that depreciation on your vehicle. There's basically two types of ways to take deductions on vehicles, and that in itself might be worthy of a whole video. But I'll tell you, for the majority of people, you're going to end up in a better spot just deducting your mileage in general. Okay, so it really depends. I will say this last year is a little bit of a different story because we're not doing a lot of business travel per se. So making a deduction of your actual vehicle costs may be more beneficial for you because you're going to have so much higher margins because you're not traveling as much and incurring that expense. So yeah, we have that. We also have this home office assistant, right? So one of the other aspects of what you're going to need to find out is what your home office deduction is. And so a lot of this stuff will help you figure out what kind of percentages you're gonna be able to take, depending on whether you rent or whether you own your home outright. What kind of deductions you're able to get. Most of the time, my average has been around $2,000 to $5,000 of home office deductions. It really depends on the amount of square footage of the office, amount of square footage of the home, amount of square footage, or if it's rented, if it's it depends on a lot of different factors, right? Whether you're going to take depreciation or not, a lot of different factors there. So I thought I would share that really quick. So that's a DBA. You're going to report that on your Form 1040 Schedule C, and just to show you a little bit what that Schedule C looks like. Pop over the IRS's Schedule C here. So you see the Schedule C, you're just going to list out if you are DBA or sole proprietorship. If you're a sole proprietor, you're going to put your name there. DBA, you're going to put, the business name, right? If it's separate from you being the proprietor, right down here. If it's just you and that's all you get a 1099, you're going to put that there, right? You're going to have gross income. You're going to have all these expenses right there that I was just talking about. A lot of those are listed here as well. At one point, you're going to get a deduction for your home office, and then you may have depreciation somewhere around here, and your business mileage kind of comes down here, and then it flows up to the car and truck expenses over here. This kind of just lists all the other miscellaneous costs you have. That's it. That's what's reported on your Schedule C. Now, this with Schedule C, 100% of your income, so you understand 100% of your income is going to be considered as self-employment income, which is going to be subject to the self-employment tax, which is actually, this is kind of a funny percentage, but there's a percentage here that they kind of try to compensate for the portion that you would pay as an employee, right? So they're basically trying to charge you for both the employee and the employer portion of FICA tax. FICA tax is the Social Security and Medicare tax, right? That Social Security and Medicare tax combines, if you have a W-2, it combines for 7.65%. If you are self-employed though, it's 15.3% because an employer matches that, right? And if you're self-employed, you're paying not only your employee portion, but you're paying the employer portion all at once, 15.3%. What happens on your tax return is it really looks a little bit like this: 15.3% times, here, 0.153, 0.153 times clear, 0.153 times 0.9235. So it's actually like 14.13%, roughly, give or take. That's what you're going to see as an actual tax that's on your tax form, right? And so you can use that if you figured out, okay, well, hey, I've got $100,000 worth of income. You're going to have that times 0.1413. You're going to have $14,130 of self-employment tax, right? So this one right here, it's really it's very difficult to avoid in this specific entity structure, right? Into a single member LLC structure or DBA structure. It's very difficult to avoid that self-employment tax. That's that's big money, right? That's 14,000, and you're going to get charged income tax on the 100,000, depending on where you are. Maybe it's with your spouse's income and stuff like that. So maybe you're in like a there's graduated tax brackets, so giving it a flat percentage doesn't really do it justice, but maybe it's around like 20% or so of that. So $20,000 plus the $14,130, you could be in a heavy tax situation, right? So that big part there is that self-employment tax. There are ways to reduce this $100,000, right? We can do some certain things with itemized deductions. We can do some other things. It depends on where we're at with that specific income tax, right? There's a lot of deductions that are available for income tax. It's not very much that it's available, actually hardly anything that's available for self-employment tax unless we change our entity structure and move our structure around. There are some things that we can do to reduce our overall self-employment tax. All right, so that's pretty much DBA, sole proprietor. Now let's talk about LLC, right? So a lot of people think that there's a big difference between the LLC, the DBA, and the sole proprietorship. The IRS considers it to be the exact same thing as the DBA or the sole proprietorship, absent an election to be treated differently, right? So with this crazy LLC thing, LLC stands for limited liability company. The LLC can be treated however we want to treat it with the IRS. Okay, we get to choose. That's one of the cool parts about it. So we can choose absent an election. It's treated as a quote unquote single member LLC, which is also known as a disregarded LLC, which means it's a DBA and a sole proprietorship, which means it's reported on the Schedule C. Interesting stuff, right? Now, let's say we make an election. I think it's the Form 8832 to be classified as a C corporation. All right. Now we're subject to C corporation tax rates at 21%. Any dividends that are remitted to ourselves, 15%. You can also be treated as a personal service corporation. It's not good, right? So there's a couple different things there as well. The big thing here is if you choose to be treated as a C corporation, we'll talk about that a little bit later, you're going to be exposed to double tax, even at a 21% rate. The effective rates have been shown to be a lot lower with an S corporation. The other thing too is that we can splice and dice up that self-employment tax with an S corp. You can't do that with an LLC, right? The LLC is going to come down to you either way. I mean, it could be an LLC taxed as an S corp. Okay, so don't get me wrong here. You can make an election to be treated as an S corporation as being an LLC, but I'm just talking about the LLC by itself without these elections. Okay, so the LLC is a state construct. It is not a construct of the federal government, okay? It is only there for the sole purpose is to limit your liability, is to create an entity that is separate and distinct from yourself. So if somebody sues you, if you screw up in the company, somebody can sue the company and they're limited to the assets that are left in that company. There's some things that you need to do with an LLC, and that is if you have expenses and you want to have a separate bank account. You want to have separate things. You want to really create a separation between you and that entity. Otherwise, the courts have pierced the corporate veil, is what they call it, and they look through to you as the individual if you don't keep some of these separate entity distinctions available and you try to you commingle funds and things like that, right? So you got to be a little cautious about how we're doing LLCs if we want to really create that limited liability factor. Once again, that's a state construct. The C corporation, S corporation, you can be an LLC and be those type of corporations, and that is a federal deal, right? It's not a state deal. That is a complete federal deal. You have to make an election to be treated like that, and you can still be an LLC, right? Okay, so next topic here. Oh, and I will say you can be an LLC and you can also be a partnership, right? So that means more than one member owns a piece of the LLC, and that person's partnership. And a partnership it's essentially a disregarded entity. If you have an LLC in your partnership, it's a disregarded entity. It's a partnership. At the end of the day, that's what it is, right? So with a partnership, if our income comes in, what we do for tax purposes is we want to show that income coming into a centralized location and saying this was all the income that was made from this particular business that was owned by two partners. And we want to show split between the two partners, right? And so what we do is we file a Form 1065, which just reports the income of that partnership, and then we're going to split it, right? And we split it with these Form K1s that gets reported. These K1s get reported like a W-2, like any other thing. It gets reported on your individual tax return, right? So if you have an LLC that is a partnership, it's the same deal because the LLC is essentially disregarded in that case, right? So absent an election, that LLC is considered a partnership until you decide to make an election there. Partnerships should almost always have a written operating agreement between the two partners. Otherwise, the end result, most courts view it as 50-50, even if you didn't put in all the money, et cetera. It really depends on how that's structured. We really need to have a partnership agreement. I'll tell a quick story. I don't know if I should get into too much detail here, but there are people that I've had it in the past, and every single time, we say, hey, get a partnership agreement if you're going to get into a partnership. No, I don't need that. This person is my brother. This person's a best friend. If you do not have an agreement in place, the agreement's just there for when bad things happen, because they do happen, right? So even if it's somebody that you trust, even if it's somebody that makes sense to make a handshake deal with it to you in your head, you just got to be cautious about this, because it is worse than a bad marriage, breaking up a partnership, because we definitely have these financial assets that are going to cause a problem. So always have a partnership agreement in place, because that allows for opportunities to fix things. We've had people that they'd always trust get punched, get punched by other people in people that they would have trusted normally, right? Because partnerships can do this to people. It's crazy, right? So always get something in writing. All right, S corporations. So S corporations function a lot like a partnership, and they can also function as like a single member LLC. They're a little bit separate from all of these things, right? So S corporations are allowable under law because they have certain limitations. You can't have more than 100 shareholders. You can't have more than one class of stock. There's a couple other limitations that you can have, but this is the cool part about S corps, right? So like we talked about before, all of your income is considered to be subject to self-employment tax, right? All of that is considered self-employment tax. Well, in certain partnership structures, if you have a general partner and then you have a passive partner, or somebody that's invested money and isn't really taking an active membership role in that partnership, the passive partner does not have to pay self-employment tax, right? Because they're not really using that to derive their income. Okay, but the general partner does, right? So there's a lot of aspects to a business that you run. And part of that is going to be from your active work inside of the business. And then the other part of it is going to be from the actual return on the business, the ROI of the business, right? Whatever kind of ROI is in there for the money that you've invested, the blood, sweat, and tears that you've invested in the business. Some of that's going to be passive income, right? And some of it's going to be due to your active participation in the business if you have a role inside the business, right? And so our government, in their genius, decided that, hey, look, it's just not fair that we're exposing people to 100% self-employment tax when some of that is obviously ROI from their business. So they created this structure, this S corporation structure, to chop that up and to say, this part right here is from our active participation in the business, and this part right here is from our passive activity in the business, right? Our investment in the business. So the way that they chop that up is they said, look, you have to pay yourself, you get this opportunity to use an S corp. You have to pay yourself a reasonable compensation. So this structure right here can't be too low, right? It can't be too low. Can it be high? Yeah, I mean, it can be high if you want it, right? But it can't be too low, and that because you can see if I structured it lower and lower, this part right here is subject to lower and lower self-employment tax, right? So if I pay myself zero, I don't have to pay self-employment tax, right? If I pay myself zero, I don't have to. So that's why they said you got to pay yourself reasonable compensation. There have been 3 really good court cases on reasonable compensation, right? Where they took people to court. And the funny thing here is every single one of them were accountants, right? They all made, I mean, there's one specific tax case that I think about a lot. The accountant made $300,000 one year, 20 years of experience. He paid himself a salary of $30,000. The IRS disagreed with this stance and took him to court, said you should have paid yourself more. So the tax court, they agreed. They said, yeah, oh, absolutely. He should have paid himself more. You know what? He should have paid himself $60,000. That's what they adjusted it to, $60,000. So when you think about reasonable compensation, do understand that, you know, sometimes it's not even that much of a difference between the two, between, you know, a smaller salary and a larger salary. You know, what we like to do here, you know, at Tuthill CPA is we basically run a reasonable compensation report, because then we actually have reasonable backing for how much we're paying ourselves, right? You want to have some kind of reasonable backing for exactly what that looks like. And especially if you understand how this kind of works, right? Because you really, the problem is you really have a pressure to go low on salary because you're going to pay less in taxes, right? So if, for instance, we paid ourselves $100,000 and we say our reasonable comp is $50,000, right? So $50,000 times 0.153, that is $7,650 in self-employment tax, right? Let's say we paid ourselves $60,000 per year times 0.153, that's $9,180 in self-employment taxes. So we paid ourselves $40,000 per year. 0.153, $6,120 in self-employment taxes, right? So it's kind of difficult to kind of discern exactly what that reasonable compensation actually needs to be. That's why we use the reports, and the reports have a bunch of factors to it. I'll say too, also, you know, if you look into the actual regulations regarding reasonable compensation, you'll see that there is a lot of gray area in terms of what reasonable compensation can mean in regards to, I mean, depending on how profitable you are as well. So there's a dependency on your profitability as well, right? So if you, even though the reasonable comp report says $60,000 per year, right? Let's say you made only $40,000 per year. Well, you're not going to pay everything out in salary. That's unreasonable, right? What is reasonable? And if you look at it statistically, what has been reasonable in the past or been upheld to be reasonable in the past from the IRS has usually been around 40 to 50% of your net income prior to paying it out, right? So, you know, $40,000, $16,000 a year is probably pretty reasonable, right? So that's something that you have to keep in mind. But you should always, if you have an S-corp, you got an S-corp going, you should always be paying yourself a reasonable compensation. Not doing so is inviting disaster, because especially if you pay yourself zero, something like that, they're going to go back and say, hey, you should have paid yourself $50,000. Now you owe back payroll taxes. Back payroll tax is bad. No, we don't want back payroll taxes. So that's the S-corp vehicle in a nutshell. Now the S-corp operates a lot like an LLC, and what I mean by that is like an LLC partnership. I should say like a partnership. So you have a Form 1120S. That Form 1120S spits out K1s, right? And those are basically functional W-2s for your individual tax return. But the S-corp, because we have to pay ourselves a reasonable comp, also comes at you with the W-2. A lot of people don't understand this, and that's why I'll explain it fairly quickly here, is that let's say we make $100,000 in our business. Right, we pay ourselves a reasonable comp of $40,000. Okay, so now we have $60,000 of leftover profit. So you're going to get a K1, which is the W-2 of your extra profits here of $60,000. You're going to get a W-2 there. You're going to get a K1 there, and then you're also going to get a W-2, right? So what ends up getting on your Form 1040? $100,000, right? 100,000. So no matter how we do it, you're taxed on the net income of the business, right? We're just slicing it up and we're saying, well, $40,000 is exposed to FICA taxes, $60,000 isn't, right? And so all that stuff gets pushed into your individual tax return. It's kind of cool stuff. C Corps. There are reasons to be a C Corp. Tax is definitely not one of them. One of the reasons to be a C Corp is that you can get public funding very well, right? It's easier to do public funding, easier to raise different classes of stock. Like I said, if you were in an S Corp, you can only have one class of stock. So you can't have preferred stock. You can't have other types of stock. So being a C Corp isn't always a bad thing. For small businesses, it usually is, right? There are some reasons like I think there's the ROBS plan. So if you take out your 401k to fund a business, which some people do as a C Corp, you're forced into the C Corp situation. You can't get out of it until you paid off the debt. But it happens from time to time. Now, the reason why C Corp isn't great is because you're going to have 21% tax, and then you're going to get another 15% tax on any dividends that are remitted to you, right? So you get double taxed, you know. And if we add up all those taxes, the effective tax rate is still better for an S Corp, and that's not inclusive of your payroll tax differences that you can have, right? The object with the C Corp here is going to be to bleed the company dry, right? Because you want to just be exposed to your individual tax rate, and you don't want to be exposed to the double tax. So let's say you made $100,000 in the C Corp. Well, you want to pay yourself $100,000 salary, right? Because if you pay yourself less than that, first of all, you have to pay yourself a reasonable comp with the C Corp too, right? There are rules for that. But if you don't bleed yourself dry here, you're going to pay the 21%, and then you're going to pay 15% on dividends when it's eventually remitted to you. So most of the strategies that you want to focus on when you have a C Corp is bleeding the company dry with the W-2, right? So whatever that is, you want to go down, like if you made $400,000 a year, you want to bleed it down with $400,000. That's literally what you have to do, right? All right, so I think that's pretty much all the entities. I don't think I missed any of them there. Now, C Corp, you know, like I said, you can be an LLC that's elected to be treated as a C Corp, and you'll see that from time to time. Oh, one other thing here, because people always think that, you know, where I incorporate is going to make a big deal to how I'm taxed, right? If I incorporate in Montana, and I am living here in Tennessee, right? I'll only be taxed in Montana. Like that's what people kind of think, right? That's absolutely not the case. The way you're taxed for state tax purposes is by what's called nexus, right? That's the ability for a state to levy a tax upon you. And a nexus is usually triggered by property, payroll, and sales, right? In a particular arena, right? So if you have a lot of sales in a particular area, you may get subject to a certain apportionment and nexus in that state, right? So that's one thing to consider. That's apportionment, but usually it's pretty much property and payroll. Like if you look at both of those, that's really what kind of triggers that nexus. And there's a public law 82-72, or no, a public law 82-272 or something like that, that kind of determines that kind of helps you govern whether or not you're going to be taxed for income tax purposes in a particular state. There are states with different taxes, and I can probably digress about way too much of the little minutia exceptions to the rule. But for the most part, you know, where you are organized does not matter to how you're taxed, right? Now, a lot of people choose Delaware, and they choose Delaware for a very specific reason, because if you're incorporated in Delaware, you can bring a lawsuit into the Delaware courts, right? And the Delaware courts are famously pro-business, right? And so a lot of people want to incorporate in Delaware just so that they can bring a lawsuit there in the future. And that's why people say Delaware. Delaware is just so that you can actually have that be a place where you can bring a lawsuit. Okay. Interesting stuff. But it doesn't matter where you incorporate. I would say, you know, for ease of use, incorporate in the state you're in. Because if you incorporate in a different state, You're going to pay the annual fee in that state, and then you're going to pay a foreign registration fee in your state, in your home state, right? So you're doubling your fees for no reason. So organizing your own state, if you can, it's usually one of the best ways to kind of get it done. All right, ta-da, that is a real quick synopsis of all of the various entities. Oh, if you have a C Corp, you file an 1120. I think that's it. All right, y'all have a good night.